Pre-usually living on this channel is for educational purposes only, is not intended as financial advice. It's Teaching Tech Tuesday. Let's talk about stop losses. Let's talk about how I think about the stop losses. For most people, these are essentially built in as an instinct. If you get good enough at trading, if you know what the heck you're doing, you're always asking yourself, where can I be wrong? Entry, exit, stop loss. Do I have a vision for what could happen here? What's the worst that could happen? What's the most likely outcome? And you should always have a rough stop loss for every trade, even a spot Bitcoin trade, right? For many people, including myself, your DCA, Bitcoin, your stop loss is 0. Your exit is potentially 250,000 a year after having, right? No matter how ridiculous, maybe it's $1 million, maybe it's 2 million, whatever it is, right? It doesn't matter what the exit is. As long as you have some rough idea for everything you're doing, okay? Maybe it's a goal. Maybe you say, I want to pay off student loans. Maybe you say, I want to buy a car. I want to buy a house. I want to pay for my mom's car. I want to pay for my mom's house, my dad's house, whatever, right? Always have a plan that's bare minimum, something that you're working towards, okay? Because with that will come a stop loss where you realize, okay, this doesn't help me get to my goal. This doesn't help me in this current trade. I want to stay at the table. I don't want to lose all the chips. Okay, I don't want to get kicked out of the casino, whatever it is. And a stop loss helps you with downside protection. For many people, their stop loss on any leverage trading is liquidation. So if you're using 20x plus 10x plus leverage, there won't be many opportunities to get out with a stop loss. Now, if you're using 5x or less leverage, again, not a recommendation, but that at least gives you some wiggle room where you can be wrong and still actually get out without liquidation. Okay, so keep that in mind. Now, if you use liquidations as a stop loss, I'm not going to stop you, okay? But there's a better way, usually. I'll talk about the ETH short I'm in currently, and I'll talk about at the very end how I'm thinking about stop losses for that. But as far as some examples, 3 different types would be absolute, dynamic or static, basically. Absolute or trailing. And then a sort of different time component stop losses. For the absolute stop losses, most of the time it's pretty easy. If you're in a breakout trade or you're looking at a previous lower low or a previous higher high or a specific psychological level or a specific horizontal level on the chart, right? That would be an absolute level for me. Some people trade with the mentality that no matter what trade I take, if I'm down 5%, I'm out, right? Or if I'm down 2%, I'm out, whatever it is, right? If I'm down 25%, I close the trade and I regroup. Fibonacci extensions are another type of kind of horizontal level that you can use. I'll go through examples of that. Trailing stop losses are probably my personal favorite, especially Williams fractals, Ichimoku cloud. If you've seen any videos on this channel, I've talked about this stuff all the time. Moving averages would be another type of dynamic level, as well as kind of channels and pitchforks. Anything with a diagonal moving average component or something that's changing over time. Other types of stop losses would be something like a time-based stop loss. We're coming into September, you're thinking, okay, I know seasonality for September's bad. I know everybody's talking about it, so it probably won't be as bad as people are saying it is because people are aware of it and they're sort of planning for that ahead of time. Whatever, it doesn't matter, right? Okay, seasonality is bad. September's bad. Coming into September 1st, I'm going to be out of longs no matter what happens, right? Or I'm not going to take any trades no matter what happens. X% doesn't matter, right? That would be a time-based stop loss where I'm saying, look, I give this trade up until September or I'm out. Another type of time-based stop loss would be, let's say, up until FOMC or up until some economic release. CPI is tomorrow. Some people say, I'm going to risk off into CPI. I'm going to risk off into FOMC. We all know probably what's going to happen in these 2 specific cases, but it'll probably be a volatility event regardless. And because liquidity is poor in the current market conditions, who knows what could happen, right? That's one way to think about it. A news-based stop loss would be, 2 examples for me would be right now. Let's say I am short ETH or Bitcoin or whatever, which I am. A news-based stop loss would definitely be a BlackRock ETF announcement, right? Something that would change sentiment, change flows, ideally. No guarantee in the near term, but something that's much different than before. Obviously, black swan, COVID, that's going to act as a stop loss for many people. But also something with Binance. We know things have been brewing with Binance for, at this point, years, whatever. But if there was some definitive headline where Binance is specifically in trouble, or maybe I'm short and Binance has to pay a fine and BNB is okay, right? Whatever it is, whatever your idea of some news-based stop loss would be, as long as you have that in mind. So before I talk about specific examples, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. So this is going to vary significantly from exchange to exchange, but let's try to put those ideas into practice just, mechanically first, practically. How do we do that on an exchange like Kraken? Let's say we have some spot ETH as I do in this account here. And let's say for whatever reason, I want to put a stop loss below the current local low, which is around 1510. Okay. So we'd select stop loss here. Trigger would be 1510. And we could choose, partial exit, full exit. Let's just say, we want to sell something. We want to acknowledge that, yes, if I, for example, bought, where did I buy ETH on this chart? I don't see it specifically. I'm looking for these little arrows. It looks like I sold some ETH here. I think what I did was I sent ETH to this account. In any event, let's say, if you bought ETH up here, you realize at this point, based on your current trading thesis, that you're wrong. We want to place some stop losses. Let's place a 50% stop loss at the current local low around 1510, right? So that would say if we get lower than 1510, there will be a market order based on the index price, which is not necessarily what we see on this exchange. The index price would be based off the CF benchmarks. I know somebody was asking me about that the other day. For liquidity and order book concerns, that's when I would probably use the index over the last price, which would be the last price on Kraken, right, on this pair. But those are options for you, right? Most of the time, it's not going to matter too much. But let's just say someone has a massive market sell on Kraken. That's obviously going to be felt the most on Kraken itself and to a lesser degree on the index. Most likely, right? This is circumstance, but okay, let's say we want a stop loss 1510. Great, we put it on the book. It'll show up on the conditional order side here. You get a confirmation in the bottom right. And then let's say we want to edit that. Let's say, actually we want that stop loss at 1495, and it'll change that order. We can also do that on the chart, I believe, directly, and say, what, I actually want that at 1537.15. So that's one way to do the stop losses. Another way to do that would be the stop loss limit, where we would say the trigger level is, let's say 1540, then we put a limit on the book at X price, and it goes from there. Slightly different, but pretty self-explanatory. All right, so let's look at examples. When we're looking at horizontal levels, a lot of times you'll see people being the market, whoever, right? They'll place a short stop just above or just below X level. Like, let's say a bunch of people were long. This is Bitcoin on the current local low, at least as of yesterday. There's a stop hunt at that level at that point, right? The same thing at the top. Yes, this was partially news-based with the Ripple announcement, but you can bet that there are people who are short in this type of environment who have stop losses at any higher high. Just as you can bet there are people who are long down here with stop losses at any lower low, right? Something else to recognize here, if you have the grid on your trading view or your charting software, certain psychological levels, especially round even numbers, typically have a lot of order book activity, let's say. For example, 25,000, right? My guess is there were potentially a lot of stop losses at that level, just as there probably were a lot of stop losses at 26,000, just as there are currently probably at 27,000. So knowing that, some of the time, you want to move your levels around accordingly, because let's say as of yesterday, you were long. Would I put my stop loss at 25,000? No, I'd probably put it lower than a longer term local low, which is its own issue, its own problem potentially. But I would look at the current local low based on the past 6 months or whatever and say, okay, where our stops are really at. There are probably a lot of stops at 25. There are also probably a lot of stops at this horizontal level. Something else to keep in mind with log versus linear. If you've got log on, you're going to get a different grid. So just, some random thing to pay attention to. But here would be a stop loss level, horizontal level, where you would probably see continuation if we got that low, because we would probably have this pile-on effect with longs being stopped out, because anybody who's still long from the falling wedge breakout, their stop loss is probably here or lower, right? Slightly lower. And we didn't quite get there with Bitcoin. And a current stop loss in anyone who's long from the bottom is still probably that level, right? So I think there's a lot of, my guess would be a lot of order book interest at that level. You can also use something like volume profile of the visible range for your stop losses to just see where's most of the order book sort of concentrated. There's a lot of interest at 23,000, not so much at 25,000, right? So you'd want to give yourself some room on any downside for a long, probably until at least 23,000, because that's where there historically has been a lot of trading interest. Looking at some random chart, similar principles, right? This is Doge. A lot of altcoin charts look like this, where it's some sort of descending triangle mess. My guess is there are people who have either mental stop losses or actual stop losses at any of these lower wicks, right? So it would be reasonable to run those stop losses and then maybe make a move higher. But as it stands now, we haven't really run any of those levels yet per se. It also represents a psychological level of a nickel, right? 0.5. So it's already leans bearish. There's already a bearish bias on this. There's probably a lot of people watching these horizontal levels thinking, okay, I'm fine until I'm below 5 cents, right? Then we'll see what kind of real bearish momentum we can get once people start to sell off. Now, if I'm long Doge, I'm also, this is just where my stop loss is, right? So I'm not long Doge in the first place, but let's say you were. Most people in general are going to have their stop loss somewhere in this range. Let's talk about the static absolute type stop losses. This would be one example from earlier this year. We had a falling wedge. With any sort of chart pattern, most of the time it's going to be some sort of higher, lower, low. In this case, it was a reversal versus continuation. So your stop loss is always easy. It's always going to be the lower low, right? This thing can look ugly. It can look parabolic. It can puke to the downside, which is why you don't really want to enter on this type of chart pattern until it does make a higher high, right? After you get your entry, then you have your stop loss. You can't just have a stop loss before you have an entry. You can have invalidation criteria, but once you get that entry, then you get the stop loss. First exit, second exit. And let's say it doesn't make your second exit. At this point, you can start to use trailing stop losses. Here's another example. Let's say you thought this was a falling wedge after the previous one, because why not? We just had another. We just had one in May. Why not another one, right? Let's say you were even convinced this was an entry. Here's an example where it's pretty clear where you're obviously wrong, right? It's obviously not going to play out how you think it is, and it pushes to the downside. Never gets anywhere close to that first exit. If we look at the current Bitcoin price, and let's say we think this is some sort of flag or descending triangle, we're going to sort of cut off any of these random pops and drops we've had. And as of yesterday, we're going to be convinced this is going to go lower, right? Where would our stop loss be? It could be 50% of the range. It could be a current higher high, which I'll show on the fractals in a second. But our target never really changes, right? We think we know where this may go, where we want this to go if we have a certain position on, and we're just trying to protect that position where we'd be wrong, right? It doesn't matter if we're wrong. Who cares? You're wrong all the time, right? You're just protecting downside risk. Another way you could look at this, that mega head and shoulders, triple top, whatever you want to call it, those patterns will always have a stop loss at the right shoulder. In this case, it's also would be representative of a higher high. So you got your entry. Here's your exit. The broad stop loss is certainly up here, but you could also have a trailing stop loss once you've entered the position. Let's look at the S&P. Earlier this year, as a pattern is building, as a trade idea is building, you may have invalidation criteria, right? You may think, okay, this could be a lot of things. This could be an inverted head and shoulders. This could be an ascending triangle. What we don't want here is a lower low. It's not necessarily a stop loss because we really shouldn't maybe even be in a trade at all until we have some sort of setup. But we never got that invalidation criteria. And once we got the entry, we certainly did not get a stop loss blown through, right? We never made a lower low. So this entire time, we continue to make higher lows, eventually getting towards our exit zone. Now, in the current S&P situation, we don't have a confirmed head and shoulders, but we have a likely head and shoulders, I would argue. So the entry would be down here. Now, if you're convinced already, right, there's nothing wrong with entering that, but just know, like, you know, this isn't confirmed yet, right? So our stop loss would be the right shoulder. Is it equal to the left shoulder? No. Is it exactly verbatim textbook head and shoulders? No. Okay. It's never always going to be like that. So just keep that in mind. So don't at me in the comments. I would consider this good enough to be some version of a head and shoulders. Stop loss and pattern invalidation would be a higher high, right? But we're technically not short yet on this. Very much a wait and see type of situation. If we roll back the clock on ETH 2017 and 2018, we had 2 back-to-back patterns at the highs. We had an ascending triangle that took 6 months to play out. Never got a lower low there. Building, building, building. Once we hit that entry, we got a throwback to the breakout point, but we never got a lower low, right? Now, this is an example of the danger that most people fall into, which is, here's the big breakout trade. Maybe I'm accumulating, maybe I don't care, whatever. But once we hit that breakout spot at 400, I'm going to move my stops to 400, because if it goes below 400, then I know for sure that this trade is over, right? Many times you will see a throwback to a neckline or a throwback to a horizontal after the breakout, and that's okay. But at that point, what you want to see is support at that level. So I know this is kind of messy and hard to see, but this is a good example. Even at 400 after the breakout, I still leave my stop loss way down here. I don't move it up immediately, right? So after that ascending triangle, you got a pretty messy, disgusting looking head and shoulders that eventually you got an entry on. And many months later, eventually reached that exit level, right? It technically didn't breach the right shoulder on a horizontal level to stop you out, but you did eat some pain, right? You did give a lot back here, waiting for this thing to reach potentially its level. So there's a point where I would use trailing stop losses, right? If it's been a month, if it's been 3 months, you better believe I'm using a trailing stop loss at that point, right? To make sure I didn't fully round trip a trade after that amount of time. Here's another example on Bitcoin before the falling wedge earlier this year, where we had, again, another head and shoulders example. You got an entry. It didn't quite make a lower low immediately. It didn't quite hit your stop loss immediately. But if you give it enough time, eventually we kind of sort of got there, right? So just because these patterns or whatever play out most of the time sort of at expected horizontal levels or diagonal levels, I wouldn't necessarily get impatient and move stops around and say, oh, we broke this neckline. That means we got to move the stop all the way down to the neckline, right? Me personally, I usually give it plenty of breathing room to make up its mind. Here's a great example of a trade I didn't take. I wasn't trading oil, but I was watching it and we were talking about it. Again, another messy head and shoulders, let's say, clearly broke a horizontal level and very clearly stopped itself out. So this saved you from 82 to 89, right? Just the rocket ship that's been oil since breaking above that stop loss level. And this is exactly what I would want to see if I was trading this. Like, yes, I believe this would break down, but when it didn't and it went against me, I was still right in placing the stop loss here, because this would have been extremely painful to just continue to watch this go higher, expecting, yeah, we'll get to 73, we'll get to 75, right? That's really the wrong way to trade. DXY, another example. Let's talk about channels and pitchforks and more dynamic stop losses. If we're short DXY and we're in this channel and we break above that channel, it seems obvious, but many people just ignore it. They say, you know what, I'm still short. Dollar's going to zero. BRICS had a conference, de-dollarization, dollar debt's going to explode, beep, boop, beep. Like they don't compute. You need to have some sort of level in mind, right? For me, it's always going to be technical, and technicals over everything. That's why I'm leaning so hard on something like this channel. But let's say you don't believe the channel. Look at the 15-200 EMAs. Look at the MAs. Look at something else, right? Some trend metric. Look at the yearly pivot. All this stuff is stopping you out of any short trade. It doesn't even matter if it goes to zero from here. It's just saying, look, trying to save you from some pain on further upside. ETH, Bitcoin earlier in the year, also the same. Let's say, we're short. We think everything's going to zero. FTX just exploded. Industry's dead. Whatever you want to think. Using some sort of basic trend indicator, channels, anything, right, can give you some idea of saying, look, we're clearly not as bearish as we were. And knowing what we know about the pitchfork, we did not return to the pitchfork, even after FTX, right? So something was clearly different, in this case, less bearish than it was. So this should really have stopped us out of any bearish continuation dreams at that point in time. I talk about alligator fractal stuff a lot, but this is one I use all the time. If I'm in some random position, some random trend, like doesn't matter what it is. When you get a low, high, low, you get a resistance fractal. When you get a high, low, high, you get a support fractal. So you can use those as stop losses. In this case, trend is telling you short, stay short, keep shorting, don't stop shorting, right? But it's also telling you this is where your stop loss is. And any candle close above that level would be the stop loss level. Another stop loss you can use in the alligator fractal system would be the midpoint of the alligator. So this is a great day as an example of that as a stop loss, right? Clearly it's above the midline, but it's also above the previous fractal. So it's kind of a double whammy telling you, be careful. Yes, this did reverse the next day, but we don't know that. So great example of a trailing stop loss system. The cloud itself is always a stop loss. Anytime we're in an active trend, bullish or bearish, and we attempt, feign, or otherwise look like we may reverse into the cloud, I seriously consider or take action on any active trades I'm taking, right? If I was long up here, I'm out once we're in the cloud, right? If I'm short here, I'm definitely out if we're in the cloud, above the cloud. And that's certainly true. Historically, it's been true. This is a wild example of October 2019 when there was some China conference and price exploded higher for a couple of days and it never made it into the cloud. So the cloud is trying to tell you it's okay to stay short here. It's okay. And we didn't actually reverse until much, much later. Looking at ETH, kind of marking it up. This is the ascending triangle, right? Now this still could be active. So technically we're not margin long. Certainly I'm not. That would be above 2000. This has a bullish bias. We expect this to break up over time. Losing this diagonal would be bad if we're expecting prices to go higher, if we're bullish, right? So one way to look at that further would be to say, okay, this is a ascending triangle. This is where the confirmation is. This is where we potentially fail that ascending triangle. Within that ascending triangle, there's this head and shoulders, right? This would be the stop loss for that idea, which is also the long entry. For the ascending triangle, great. We had an entry on the short signal side of this equation, and it continues to lean short. You know, it's in a very precarious moment. I would say a trailing stop loss somewhere above 1625 or whatever that is. But if this breaks down, this is where price wants to go most likely. Now we could always revisit the lower lows all the way back, but because you have this entry exit stop loss dynamic idea in your head, at least I do, I'm okay with trading this short, hedging, whatever it is, even though there may be a broader bullish dynamic at play. I know where the stop losses for me are. Here's an example because I know a lot of people are looking at this weekly edge to edge trade, right? On these type of trades, once we're in the cloud, your stop loss is the cloud. So you don't want to fall out of the cloud on an edge to edge trade. So going forward, months from now, any stop loss on an edge to edge move would be anything below the cloud. So depending on how this looks, you have considerable wiggle room, or kind of ideally you don't, right? You are kind of at that stop loss until the breakout. You have some room, enough room for shenanigans, but if it goes against you, you're out quick enough where it doesn't hurt significantly. So if we're marrying everything together, my ideal stop losses are a combination of the cloud and the fractals. It tells me the trend. It tells me intra-month, intra-week with the TK crosses. It gives me re-entry signals. It gives me stop losses, all sorts of fun stuff. That's all I have for this one. Let me know if you think this helped. Let me know if you want me to go into anything more specifically or deeply that I haven't already talked about. Like, dislike, comment, share, subscribe, and happy trading.